Woohoo! Here we go. Hello to the millions who are out there watching me. Thanks for joining the very first moment of the very first Get MorAlpha show. I'm here in my so-called studio in my living room, and there could be one half a human being out there watching me. But to me, this is still beautiful to do because over time, if I can build up a following, you can always go back into my YouTube channel and see the old videos. My name is Mora. I have founded an entity I'm calling MorAlpha, and you are watching MorAlpha's very first training event. And so now I'm going to get to a presentation that I've prepared for us. And the name of today's show is Blast Off because it's the very first show. My original plan was to have the Apollo 11 Blast Off open the show instead of me stepping down into my chair. But I tried that in a test video, and then I was blocked for using copyrighted video, so I learned a lesson. Anyway, so here I am just doing it myself with my own source materials, and that's perfectly fine. Here we go. We're going to get into this presentation. So I'll go over to that screen. And get it to full screen. I'll wait a second because I think there's a little latency. Okay, here we go. Before starting, because this involves, and I should say from the start, this is a 1 hour show. I'm looking at the clock. I'm already in about 5 minutes, 4 minutes, but we will really be busy for the next 55, 56 minutes. But before starting, because the topic of all this is about investing, I have to be very careful and very clear about legally what I'm doing here. All I'm doing is sharing information. I'm just educating you, okay? And so I am not a broker, and my little company, MorAlpha, is not a broker, not an investment advisor, not a financial planner, not an investment manager, not a hedge fund, not an investment bank. Okay, I don't have licenses for that. At one time I had licenses that I needed to do my work in investment banking, but since I've retired, that has elapsed, and I don't need those licenses to do this work, which is just to educate you. We do not make explicit investment recommendations, and you're going to see this. My pattern is going to be that I'm going to teach you about investing, and then you can make your decisions. Naturally, you can come and you can ask me questions, but even in person, if we get to talk or if we get to meet, I think you're going to discover quickly I'm very much in the mode of helping people see what's out there, but not in the mode of really dictating what people are going to do. I think it's better this way. This way you own what you've decided to do. And then I've not placed you or me in a position that's awkward because maybe you feel like I pointed you in a direction that ended up not working for you. Of course, that would not be what I would ever wish anyway. I'm optimistic about all this. I think you're all going to do well, but the legal side of things is a reality that we live in. We live in a legal environment, especially in something as sensitive as people investing their very hard earned or very hard saved cash. So we are unaffiliated and independent, and we work for you. We are, because we have nothing to do with any of these entities, and everything we're sharing is not about pitching you, about trying to sell you stock or trying to get you to get us, let us invest your money for you and get a fee. It's all for you. And in fact, this video is so for you, it's free. It's in the seminars where I will charge, and I'll get into that. So MorAlpha's success is going to be just based on the quality of the education that we give, that whole educational experience. Do you feel like you've learned? Were you bored? Was it interesting? Do you feel like we are competent, like I know what I'm talking about? I suspect you're going to think that I do know what I'm talking about very soon here as we get into this, because I lived 25 years of my life in this. I do believe this. This is really important. The reason for selling knowledge, and not just selling somebody an investing strategy, which some people do out there, is because knowledge ultimately underneath everything is going to, the more knowledge you have, the better chance you have that you'll succeed in achieving the goals that you set. Because with knowledge, you set realistic goals, and you know how much risk it takes to try to get to those goals. And you also know you might overperform or underperform those goals. That's what real knowledge is. That's what real investing is, as opposed to gambling. We teach every approach. Some people think, well, is this a quick get rich quick kind of a course that Al's going to give? No, this is to teach you the ways that people trade. And here they are, some examples. Long-term hold, just buy investments and hold them. You can do that. You can buy a portfolio that fits your goals and you're done. And people do that all day long. I wouldn't be surprised if most people who own stocks, probably through their account at work, just have designated a certain amount of investment to make every 2 weeks when their paycheck comes out, and they just buy and hold. You could do something that's called an optimal portfolio, which is similar, because an optimal portfolio, once you've decided what that is for you, you get into that portfolio, and it's a little more sophisticated than just a long-term hold kind of a strategy, but there's not much activity there once you've made that decision. Or you could be an active trader. You could do day trading. And these are the people that maybe think they want to get wealthy very fast. Well, some people who are not only day trading, they're hour trading, minute trading, second trading, and microsecond trading do make a lot of money. And we will talk about that. There are these trading strategies or styles like trend trading, correlation trading, arbitrage, in event and in news trade and news trading, macroeconomic trading, for example, trying to take advantage of your special knowledge and paying close attention to things like interest rates or inflation rates or unemployment rates around the world. That's macroeconomic trading. Automated trading means you're using computers, or algorithmic trading means you're programming a computer to do trading, to do a lot of the thinking that you've already pre-planned for it to do without being sure how it's going to end up trading, because you're not sure how the market's going to behave. Okay, so our stocks, there's just something worth talking about right off the top of the very first show, though. If any of you, if you are watching the markets, this could be a time when it is riskier than average, and could be a lot riskier than average, to buy stocks. Having said that, it's been that way for a while now. And so here is an indicator that it's called the S&P 500 price/earnings ratio. And lots of people call it the PE ratio. And what this is, we're going to look at a chart of this ratio. And what this is you take the price of the Standard & Poor's 500, all the shares, all their value, and you divide that price by how much they've earned in the last year. Because ultimately, and here's a line that shows right where we are. So if you look at the end of the blue line, and right where the red line touches the end of the blue line in 2020, this is where we are. And the blue line shows where we've not been at this price earnings ratio very much historically. This is much higher than average. And here we see the current S&P price earnings ratio. So let's think about something real important here. Very fundamental. And I'm going to constantly be using that word fundamental as opposed to what other people use, which is technical and other indicators. I'm about really understanding what you're doing. That means fundamentally, what are we all doing? What are we talking about? What are we thinking about? Okay, fundamentally, really all, and I mean every bit of a stock's value comes from the expected future profits of that stock. Stop and think about it. If a company issues stock and you own all that stock, so you own the company, and all of a sudden that company announces they will never make profit again, you know what that stock's going to be worth, a zero, okay? And if they're going to make a little bit of profit, well, you being the owner of the company, you're going to get that profit, then it's worth a little bit of something, all right? So the point is, if you have earnings that you're expecting to have in the future, there's a certain price that seems to correspond reasonably to, in proportion to how much you expect to earn. And over time, that has been around 15 times. In other words, let me say it this way. The average stock has a price historically that is about 15 times what that stock earned in the last year. But now we're well over 20 times. If you look at the graph on the left side of the chart and you see there's a 10, a 20, a 30, and a 40, you see that we're over, that red line is over 20. So that means we are in territory where the market is, we call it rich. Now let's look at that area between 2000 and 2010 that has a gray bar going up and down, where it really, the blue line shoots way up. Here's what happened there, okay? I'm going to get right to the explanation. Here we go. During the 2007 and 2008 crisis, read the red writing here, follow my cursor, we had that financial crisis, and profits fell very fast. but stock prices also fell, but not as fast. And so that, for a while, that made the S&P 500, the stock prices look very high compared to earnings. And actually, think about it. If the price, if earnings are that are being used are for the last year, as you move forward in the beginning of a bad year, you're still including earnings from very good years, right? So you have a lot of earnings. And heck, I think I'll confuse this if I get into this too deeply. Suffice it to say that when companies suddenly don't make much money, the market can crash and the price earnings ratio can look artificially very high. We can kind of ignore that period. So throw that one out, and we can say that prices are very rich right now. So be careful if you're going to get in there and invest. I thought I would start this whole thing with that word of caution. Okay. So now, one last thing before we get into the real presentation, and that is, here I've called my company MorAlpha, and so I'm going to say what alpha means, and that's the last time we're going to get into alpha in this show. Here we go. So alpha is the most useful measure of an investor's success. Alpha is taught in universities and used by most investment pros, and here's why. Because alpha looks at a portfolio and sees how risky it is, okay? And then it says, wait a minute, okay? A portfolio that's this risky should earn about this much money. Let's see how you did. If you did better, then how much money you should make given that risk. You did well. If you did below, if you made below what that risk level says you should make, then you did poorly. And if you made about the same, you did okay. So here we go. If your alpha is below 0, it's below average, okay? And that's acceptable if it doesn't happen often and if it's a small miss, okay? But an alpha of 0 is actually not bad. Sound investing will get you an alpha of 0. That means you're the average investor. The average investor, we're going to see, makes money in the stock market. That's why it exists. If the average investor did not make money, it would collapse. There would be no stock market. And then if your alpha is above 0, then you are above average. And that's impressive if you can keep doing it year after year. And there are companies that have done that, particularly hedge funds. But mutual funds, which a lot of people invest in, actually, because of the way they're constructed and the fees that you pay to be in the fund, they're really already structured to where you're already losing 1 or 2% just being in that fund because they're managing it for you. So that takes away from their average return. So on average, they have negative alphas. On average, mutual funds do less well. But the idea is at least the mutual fund gets rid of a lot of risk for you. We'll get into that. So what you're really saying is, okay, mutual funds, I'm going to accept a little bit less profit, but I'm going to let you manage my money. I'm going to buy your mutual funds, accept a little less profit because you are making me safer. And you could academically argue why that doesn't work, but that's the mentality for why they exist. That's how mutual funds actually make money. Okay, no more about alpha today, but if you're curious, here's what alpha is. And this you can pause and look at it later. Alpha is actual return minus the expected return based on the risk of a portfolio. And so the ERBPR, the expected return based on portfolio risk, ERBPR, I made that up. But that is something called the risk-free rate plus something called the beta times a market return minus the risk-free rate, kind of technical stuff. Beta measures how hard it is to hedge a portfolio, and alpha is actual return minus ERBPR. That's enough about alpha. That's the most technical we're going to be today. Okay, now here we are. This is the Get MorAlpha show, starting all over again 15 minutes later. Welcome aboard. And here's our agenda. We're really going to get through this too. I'm looking at that clock, and I'm going to get us through an hour. In 1 hour, this whole agenda. We're going to talk about an investment revolution we are undergoing right now, about what MorAlpha is going to do, how we're going to teach, what our plan is. I'm going to teach types of investments, and I will stop and say before I keep going here, today's session is going to be different from all the others in this regard. First of all, we won't be introducing ourselves very much in future shows. And also, we're going to really leap forward, and we're going to keep it light and skip the details today so you can have a sense for what investing really is broadly and generally. Okay? And here we go. Here's what the process of investing is. It's that let's back up and have fun and look at this bullet point. You learn what types of investments are. What are they? What do they do? What do you own when you own them, right? Some of you might know exactly what a stock is. Some of you might be quite vague. There's nothing wrong with that. This is what the class is for, to teach you. There was a time when I knew nothing, right? I didn't know what a stock was. And then isn't it important to learn, well, what does a stock earn on average and how predictable is that? Okay, so you're going to learn how much investments earn, each type of investment in broad categories. This is today now. We're going to look at types of investments. We're going to look at how much they earn as broad categories. We're going to learn what risk means and how risky these investments are. We're going to do a little budget, a pretend budget. It's not going to be painful. It's already made out for us. It's a pretend budget. And then we're going to use that budget to set an investment goal. And once you have an investment goal, you set a strategy. Because once you've learned, let's go back. Once you know what types of investments are available, how much they make, especially how much they make, and you learn how risky they are, and you've gone through your budget, then you can say, well, I would like to earn this much per month from my investments. Oh, well, now you've got a goal, and you can create a strategy based on what you know about how much investments earn that will reach that goal. And you can look at that risk and ask yourself, is that too risky or not? Okay. So then the next step would be very practical. You will select the type of investment account. Where will you go to? Will you go to a broker and let them just buy stocks by calling them on the phone and placing your own orders? Will you get an investment manager or a hedge fund to do all the work for you? So we're going to pretend that we're going through the whole process today, and we're going to select in this show a type of investment account. And then we're going to look at what an online investment platform looks like with actual screens. Then we're going to get into the sales pitch a little bit, because I'm going to talk about what our seminars are going to be like. The name of my seminar I've created is the Investment Universe Seminar. I love science, so I couldn't resist putting the concept of a universe in there. But actually, philosophically and even mathematically, there are a lot of amazing connections between the mathematics of the universe and the mathematics of investing. I won't get too heavily into that stuff. But anyway, certainly not in my seminars. But I'll throw a smidge of that here and there in case you're curious about stuff, because there are people who are very curious about these connections. If you love pure math, or if you're very curious about why in the world the math that works for predicting how atoms move also kind of is the math that works for predicting, for calculating the price of an option. Incredible, but true. And then we're going to talk about what we do in terms of community work. Okay, here we go. So we said we would look at an investment revolution on our agenda, and here we are. Here is the revolution. In 2019, something changed. In 2019, a big hole was blown in the wall. And you know what this wall is? This wall was the broker's wall. This wall was the wall that on the other side, there used to be large investment managers, hedge funds, and investment bankers, and individuals who had large portfolios who had access directly to the market, who could buy a stock a little cheaper than the rest of us, and who could sell a little more expensively than the rest of us, and who could even do more, like move the market in their favor a little bit. All kinds of stuff that they could do, that we could do, and they could get really cheap and often zero commissions when they were going in to buy stocks, whereas the rest of us were paying big commissions, $30, $40, $50 for a phone call to your broker, or some percentage of your acquisition that you went into that went straight to your broker was blocking you from getting in there and buying and selling and being in the active in the market. So now what do we have? Look at my cursor. State-of-the-art interfaces, big boy trading prices, meaning we've broken through the wall because of the revolution. And now when you buy a stock or sell a stock or bond or currency or an option or a futures contract, you're going to get a price very close to the best prices that people are getting in the world at that moment in time now. This is driven by broker industry consolidation. We have something that is really great also that's happened, is that now when you go in these platforms that you can get into, you can buy stocks and bonds and other assets all over the world. You can trade 24/7. And now other people who had access to all the other markets that would take advantage, that knew that in the morning, maybe they might be able to sell something more expensive in the US that they had bought maybe in Japan or in Germany the night before, that advantage is gone. We're all in there if we want to be in there all day and night, and we're not going to get arbitraged because we get up later than they do and they've been up all night. And then now an individual can even do high-speed algorithmic trading. There are millennials who are doing this. I've watched videos, and there are kids who learn basic little programming language, like one I think it's called Python, and they put in orders, and they have this order system ordering, the computer ordering trades for them automatically. All right, so here we go. The day of online investing for everyone has dawned. We, MorAlpha, is here to alert and educate you. And here is Here are the two biggest factors that make this absolutely incredible to me. I never thought I would see this. You can now open an investment account with all of these features that I'm talking about that you used to have to pay a lot of money to have, millions of dollars to have. You can now have this for free with no minimum balance. And the other mind-blowing thing is, and you don't pay commissions when you get in there and place orders, or the commissions are so small, they're practically zero. We'll see that. We'll see that in following slides. And you have features now like free automated investment management. Some of you have portfolios. You have an investment manager, and they're out there charging you 2% to manage your portfolio. These platforms now can do the same thing your investment manager is doing for you. You go in there and it interviews you, or you learn some of the investment management options that you have, and you pick one, and it does what your investment manager does. It buys the right amount of stocks, buys the right amount of bonds, buys the right type of stocks in the right industries, the right bonds issued by the right entities, and then when it gets out of balance, it rebalances it. And you've told it ahead of time whether you should reinvest that money or you should go ahead and put it in your cash account. Incredible, okay? Now you can get on your desktop, your laptop, your tablet, or your phone app, and you can trade, okay? And we didn't have that mobility. We could not trade on our phones when I was an investment banker, and now I doubt it because of security, but maybe. I've been retired for 7 years now. I'm not sure what everyone's doing. And I got on the phone with some friends recently because I've started this show, and I started asking questions about changes that are occurring in the industry. And future shows will get into that because there are changes occurring in the investment banking industry. Here's why. Because investment bankers provide services to gigantic corporations, and well, heck, they can jump on these platforms just like you and I can. So maybe these platforms are so good, they don't need the investment bankers anymore. We're not there yet, but that could happen. Anyway, something, again, worth re-mentioning. It's meta-mobile millennials, the MMMs, the triple M's, right? Video gaming stock, so to speak, getting on their phone app, having a little money. They're just in college, learning how to program, and they realize I can buy and sell stock, and I could just have a little tiny portfolio, $500, $1,000, and I can learn to trade. And next thing they're doing algorithmic trading. So here we go. We've got through one point on our agenda. We have discussed what the revolution is. Now we're going to learn who MorAlpha is. All right. Next item on our agenda. Here we go. I am Albert James Mora. Let's look at the cursor. I grew up in, let's see what I have here. I was born in 1958, right there in East Chicago, Indiana. This is a map of the Chicago area. And here is East Chicago, Indiana. Here's where the Bears play, the White Sox. Here's University of Chicago, where I attended. Here's JP Morgan Chase, where I worked as an investment banker. Used to be called First Chicago. And here's where the Cubs play. And here is the JP Morgan Chase building. We'll look at that more close up in a second. I went to East Chicago, Washington High School, attended Purdue University, bachelor's degree in business there, got an MBA at the University of Chicago with a concentration in statistics and a concentration in finance. Either one of those concentrations would be a really good qualification to go and become an investment banker, and having both of those was a great qualification to have entering investment banking. And I can say it really did pay off. I really did use the tools I got in my MBA program when I started working on a real trading floor. I have 5 kids and 3 grandkids. That's the personal stuff. Now, on my career in investment banking, I worked in 2 entities where I was really what I would call an investment banker. At JP Morgan, used to be called First Chicago, and at Hyundai Capital America. And interestingly, after my MBA, JP Morgan was the first place I worked, and Hyundai Capital America was the last place I worked. In between, I worked in corporate treasury, and I worked at Ingram Micro out on the West Coast, Beckman Coulter on the West Coast, and NiSource in Maryville, Indiana, right near where I grew up. And my very first professional job in investing actually was before I graduated at Purdue. When I was still a junior and only had a few classes left to graduate, I interviewed for and I got a job I did not think I was going to get. And they hired me because I had fantastic grades. I interviewed well, and they knew I was close to graduating. So I actually had got my first professional investment management job nearly a year before I graduated from Purdue University. All right. So here's what I did when I was working. I managed investment portfolios. That was City of Gary. That's where I started off, managing the city's investment portfolio, which was, if I can recall, something like a $50 million investment portfolio. Not bad for your first investment portfolio at that time, especially. I transacted over my career in stocks, bonds, currencies, and then something that's very specialized, that is rare. It's rare to have transacted in stocks, bonds, currencies, but also have done derivatives. And I did a variety of derivatives. I traded futures, options, and swaps. And remember, all of this was done institutionally for my companies. I wasn't doing this for my own account with my own money. I was an employee who was being paid to do all this transacting on massive scales. I managed currency and interest rate hedging programs. That was very important during my treasury work. But even as an investment banker, I taught people to manage currency and interest rate hedging. So when I decided to leave investment banking and move to the West Coast, I was able to get a treasury position because they were excited to have me on board, because a corporation that was hiring me, Ingram Micro, knew that, hey, normally they pay massive fees to spend just a few hours with an investment banker. Now they were going to be able to bring one in-house. And that happens. Investment bankers do enter treasury sometimes when they have this lifestyle change. And what I was doing was just adapting my lifestyle to accommodate my family, to fit my family lifestyle. I had kids, and I didn't want to be on the trading floor at 6:30 in the morning and traveling in planes and traveling around the world. I had done enough of that, and I loved it, but it was time to focus on the kids. And that was fantastic. Everywhere I worked, I was a training instructor, and I was even a committee member on training teams. So here, let's back up just a second. Here's First Chicago, but let's have a close-up. Here's beautiful Chicago, and here's the building where I worked. First Chicago, then this was called First National Plaza, because First National Bank of Chicago was there, and First Chicago Capital Markets was there. First Chicago Capital Markets was the investment bank. Now I live in beautiful Carlsbad, California, out here on the West Coast, just south of Los Angeles, just north of San Diego. And there's the coast. It's incredible. That's a shot there toward Tijuana. Tijuana's back there behind these hills. This might be Tijuana back there at that point in the photo. Here's a photo I took. This is from the beach right this way. So if we walk this way about 3/4 of a mile, we would be where I was standing when I took that photo. And so I'm proud of this photo, but around here, people take these photos. All right, here we go. MorAlpha has values. Let's get through these. Sustainability. Sustainability in my personal life, but sustainability as a business. Corporations are doing this more now, and we'll get into that. Connection. My connection with you. We are all now entangled, physicists like to say, if you're watching this. We have a certain connection, and that's why I'm here. I'm here because I want to create, as much as I can contribute, something sustainable for us on every level and every dimension, including, in the dimension of investing. And that leads me to then, well, what's the point? The point is that I have connection with you, and that's why I want to act, think, speak sustainably. We're going to act with integrity. I think you're going to get that very quickly. If you already know me, you already know this. But when you watch this video, you're going to understand something. All of this collapses if we don't have integrity, if we don't have a default setting that says, I wake up and my eyes open with integrity, and they close with integrity. If we don't have that, that's a goal to pursue. And no one has perfect integrity. It's not about being perfect. That's preposterous. We're not gods and we're not machines. We're human beings. Integrity, though, is where we pursue it. We strive for it. It's the ideal. And then when we don't reach the integrity we want to reach, we don't sit around and don't regret it and don't mope about it. We just let it, we internalize it and keep moving, because that changes us. So long as we make integrity the priority, then that natural evolution happens. So the idea to me is not that integrity is painful and it's dreadful, and it's a burden. No. Integrity is light. Integrity clarifies. Integrity keeps us focused, and integrity enables us to forgive ourselves and to maybe even set an example and inspire other people. And of course, an important value is service. In the end, I'm going to work for you, and I'm going to provide you a service. No matter how much integrity I have, if I give you nothing, it's nice. I'm a nice guy if I have integrity, but I'm here to work for you. And I've been working very hard for the last 2 weeks to get this presentation ready, because I just became aware 2 weeks ago that this was all available. I'm retired since 2012, and I would not be sitting here if 2 weeks ago I had not learned about these zero minimum balance, zero commission accounts. Here we go. My logo symbolizes our values, okay? I say our because I do plan for this to be an entity that will have more than one person. It's going to be a one-man show, but at some point, relatively soon, I think, I'll have assistants in some form, maybe students that I can pay so they can learn and they can assist me, because running the website and creating each show every week and preparing seminars is going to take some work, and I can foresee needing some help, and that'll be wonderful. So this is a we organization already, right? Even though it's me by myself, sitting here by myself right now. All right. Let me move this camera up a tiny bit. Okay. So here's the logo. We offer alpha service, right? We had those values. What were they? Sustainability, connection, integrity, and service. And here they are in the logo. Let's start from the bottom. Silver background represents sustainability. Blue to red. Have you ever seen those colors used anywhere before to symbolize people's orientations? So blue to red symbolizes connection between all of us. I'm not on one side or the other. I get both sides. I don't get frustrated. I embrace all of it. The whole democratic process is a tough process. Read the history. Even when they were writing the Constitution, there were bitter battles just to write that thing. And there have been bitter battles every inch of the way. And right now it may look more contentious than ever, but that's not true. It's contentious, but the political contention has always been and will always be with us. So I prefer we have less of it, but I'm not shocked or angered by it. I understand what got us here, and I understand where we are, and I'm hopeful. I don't know about optimistic. I think I'd say I'm slightly optimistic, but I am always hopeful. That's the part that I will never, ever allow anything or anyone to take away from me, and I hope I can infect you with that. The amount of hope that we have is our own choice, and I own my hope, and my hope is endless. It is what drives me. It is what pushes me. Why? I have children. My hope is for them, and I'm going to send out this hope energy into this universe for them and for you. All right, continuing. We're through the logo. We get it. Alpha service, integrity, connection, and sustainability. Here we go. We got work to do. 25 minutes. We have a mission, and our mission is to proliferate self-determined, knowledgeable investing. I'm going to repeat it, right? I'm not here to tell you what to do. I'm here to teach you what to teach yourself and how to go through the process that has the best chance of making you an investor that can set goals that you understand and hopefully achieve those goals. And there's a good chance you will achieve them when you go in with good knowledge. Okay. Also, really importantly, and if you go in there with sound knowledge, then you won't have the shocks either way. Okay. If things don't go well, you'll know why they didn't go well. And when they go great, you won't sit there wondering what happened and think maybe you were purely lucky. Maybe things went great because you're skillful. Okay. So how are we going to do this? We're going to stream. We're going to have this show every week. We're going to do specials every quarter. I'm going to give you some examples of what those might look like. We're going to have live seminars on streamed. We're going to have streamed live seminars semi-annually, but we'll have more than that in person. You'll be able to come to Carlsbad and see and meet me and do seminars right here in town, right by that beautiful near that beautiful beach. Everything will be streamed on YouTube and saved on YouTube, linked to Facebook, so you can find us very, very easily. We already have our YouTube channel up because you're on it, you know that, and we have our Facebook channel, and many of you came on board today through the Facebook channel. All right, so here we go. Here are our topics that we're going to cover. This is going to start going fast. Topics that are going to get covered in shows and in seminars. Okay, so some of it I've already discussed. I'm going to explain well in some detail what is a stock, what is a bond, what's a mutual fund, and what's this ETF, the exchange traded fund. Is very important. It might be the most important thing, type of investment for most people. I'm going to predict that it is the most important type of investment for most people. Then there are options, futures, indexes, and currencies, and we'll explain enough about those at least to know this. Whether or not you should even consider investing in those, because some of you should consider investing in those, and some of you shouldn't be bothered. All right, but if you know nothing about them, you wouldn't know why. So I'm going to teach you enough about them to at least know why you do or don't want to do that. All right, what are our resources going to be? News, market trackers, charts. I'm going to teach you to get these resources, how to get company reports, analyst reports, bond ratings. I'm going to teach you about service providers and what they do. What do brokers really do? Investment advisors, investment managers, hedge funds, the role players in this world that you talk to when you get in. Who are they? What do they do? I'm going to help you get started. Compare platforms. We can look at Charles Schwab, E-Trade, Fidelity, Interactive Brokers, Robinhood, TD Ameritrade. We can look at analysts, the role of stock, ETF, mutual fund analysts, and bond rating agencies. We can learn to read financial statements. We're going to cover reading your own monthly report that you get from your investment manager. Some people really get that report and never look at it because there are 1,000 numbers on that thing. They don't know where to start. And there is a way to start. It's the top-down method. You look at the most important numbers first, you learn what those are, and then you learn what makes up those numbers, and that's in the report, in the details. So you look at the biggest number, and then you look at the subcategories that add up to that number, and then you look at the subcategories that add up to those subcategories, add up to those. All right. We're going to learn about the relationship between news and investing, because if you're an active trader, you watch the news and you pay attention. For example, if the market really, really goes down, well, then it's important to look at it and think about whether or not you're going to stay in or not. Or if it really rises, whether it's time to sell. Okay. We're going to talk about activist investing and green investing, financial planning and budgeting. And we're going to do some of this today. Business education and careers, very important for me. If I could get anybody to enter the investment industry, and I have already in the past, and if I can do more of this, motivating people to get into the finance industry, well, that would be fantastic as far as I'm concerned. It's not that it's the only thing that there is to do in this world. We need scientists, we need doctors, we need everybody, by the way. We need the guy who comes and does my landscaping. We need everybody. But you understand, you get the point. I'm talking about careers here. All right. So then there are intermediate and advanced. These prior topics were more basic. We're going to get into measuring risk, volatility, and beta that I mentioned earlier. Investment efficiency, alpha. Something called a valuation formula that's also called present value of future cash flows. What's an optimal portfolio, which combines stocks and bonds? The people who came up with this theory for optimal portfolios, they won the Nobel Prize. Okay, so it's important. It's called the capital asset pricing model. Important for me to teach that. I'm going to teach about margin investing. That is when you borrow money to buy stocks. It could be a good idea if you do some of it. It could be reckless if you do too much of it. So we'll learn about options and futures, making money when the market goes down, high-speed trading, financial statement modeling and valuing companies. Some people, like I, in the past, have actually gone through the financial statements of companies and tried to predict the future and see what their stock should be worth after having predicted the future for the details of how that company is going to operate. Our revenue is going to grow or fall, our costs going to rise or fall. What's the company saying its business plan is going to be, and how does that business plan translate into stock value? Will the stock value go up? We're going to get into the real heavy stuff a little bit too. The capital asset pricing model I already mentioned, fundamental stock and bond valuation, which is kind of the same thing as CAPM. International financial institutions. Who's out there? There are central banks. There's the World Bank. There are retail banks, corporate banks. There are investment banks. There are investment managers. There are real estate entities. There are insurance companies. Who are all these people? I'll do a show on that, and you'll get it. They all interact with each other in a very sort of natural, interesting way. And I'll talk about U.S. securities regulation a little bit. That's not the most exciting stuff, but it's relevant. It's good to know. I'll get into some economic stuff. I'll look at really interesting things to me, like Nobel Prize winners, particularly University of Chicago, which is the dominant player. They are, I don't know if there's ever been a team in sports that dominates education in finance and in economics, like University of Chicago and all the Nobel Prizes they win. They're far ahead of everyone else. And so it's amazing to me that I attended the University of Chicago. I'm so grateful. And then I'll have some neat stories about superstars of capital markets. I'll talk about my career sometimes. I'll tell you what it was like. How did I get the interview to get into investment banking? How did the interview go? And I did other interviews. How did those go? Why did I choose that investment bank? What was my career like? Okay. Then the specials will be fun things like books, movies, science, sports, music. And I look forward to interviewing people, including some of you out there who may be watching or who will watch this at some point. I will ask you to let me interview you. We've got through 2 bullet points here, 2 check marks. We got a lot of work to do. Here are the types of investments, okay? And again, this is cursory today. When we get into these real training sessions, this will get way more detailed. But here's a stock. Here's something called securities. And securities include stocks, bonds, mutual fund shares, and ETF shares. When people say securities, mostly they mean that. They don't mean options. They don't mean futures. They don't mean indexes. They mean stocks, bonds, mutual fund shares, and exchange traded fund shares. And so these are issued by companies, funds, governments, and agencies. But here, now let's get into some of the securities. Stocks are securities sold by companies, and they give the buyer a proportional ownership of the company. For example, Ford, Apple, or Alphabet issue shares. Alphabet owns Google, by the way. And isn't that a clever name? Alpha Bet. bet on alpha because alpha is a good measure of performance. These are smart people at Google Alphabet, good name for the company. All right. Bonds are securities issued by companies, could be issued by governments too. And that's a loan. They're issuing these bonds, and by the moment you buy a bond, you just lent the company money. When the bond matures, they pay you back. Or you can sell the bond. And so bonds are fantastic instruments because they give many, many different people the ability to lend money to corporations. And you can, instead of just lending some big amount of your pocketbook to one corporation, you can split it up, buy one bond or a few bonds from a bunch of different corporations. And it's less risky. Instead of lending all your money to one corporation, if they go under, you lost it. Okay. And for corporations too, it's a way of them finding a diverse set of lenders and not having just to go to banks to borrow money. And they do go to banks to borrow money. Trust me, they do it more than anyone does. But in addition, they issue bonds. Okay, mutual fund shares. Here we go. This is where it starts getting thick and important. These are securities. Notice I say mutual fund shares. A mutual fund is an entity that gets created that issues shares that you buy. You buy those shares, and what do they do with that money? Take it home? Well, they do take a little bit of it home. But what they do is they buy stocks. And instead of them buying just the stock from one company, they buy a whole variety of stocks. And that way, instead of you having to go and discover 100 different companies, 500 different companies that you've got to figure out and then make 500 orders with your broker, instead of that, you buy one mutual fund share and they do all that work for you. And that's why they charge that fee. And that's why, on average, they make less. Let me say it this way. Their shares that you buy make less than the average portfolio because it takes work to do with that stuff. Okay? So they do this portfolio rebalancing and they promote buy and hold. What that means is when you buy their shares, it's not easy to sell it right back to them. You buy the shares from the mutual fund and then they'll tell you got to hold on to that for a while because they don't want too much in and out. Whereas exchange traded funds is a modern type of mutual fund. They've been around for about 15 years, but they're exploding in popularity. There are a bunch of technical, like mechanical reasons why exchange traded funds weren't really possible before computerization came in. But now that everything works quicker, now that there's more integration, these funds enable this. Mutual funds settle every day, once a day. At the end of the day, they set their stock price based on the value of all those stocks and bonds they're buying in a given fund. But an exchange traded fund literally all day long in real time is resetting how many shares of the fund are out there, how many they're going to buy and sell to make that exchange traded fund share value, because you're buying shares in the exchange traded fund, to match the value of that stuff that they're buying. Because when there are differences, if exchange traded fund share values are lower than what those assets are in the fund, somebody else can come along and buy the exchange traded shares, and eventually they even up and they make a profit on that. And that's not good for somebody to call it an arbitrage on that. Okay, we've got through types of investments. And now, how much do investments earn? Do you have any idea? How much does $100 of a stock earn per year? $1, $5, $10, $20, $50? Write it down. What do you think? A buck? $100 of stock. How about, and in 10 years, how many years out of 10 does a stock lose money? 1, 2, 3, 4, 5 years out of 10? How many years out of 10 does an average diversified portfolio lose money? 1, 2, 3, 4, 5 times out of 10 years. How much does $100 of U.S. Treasury bonds you earn per year on average if you buy very safe bonds? And how many years out of 10 do those lose money on average? Okay, write down your answers. We're going too fast. You won't be able to write down your answers, but we're going to know the answers in a minute. So here we go. This is an algogram, and it's a chart that's very special because notice it goes from -100 to 100. I made it up. I named it after me. And it shows how many years out of every 100 years, in this case, the average individual stock, right, makes 0, about 9 times, or between -5 and +5. How many times does it make around 10%? From 5 to 15, it makes it about 11 times out of 100. So this is how many times out of 100 you make 100% or more, 90%, right? That gives you a flavor. Well, that's very risky, isn't it? Isn't it? It's very spread out, okay? So these are our algorithms. Don't worry about reading all the yellow points. You can come back to those. You can pause this later and watch it. But here's McDonald's, and notice something about McDonald's. They're not as risky as the average stock. And here's what the average return per year is. They make 12% on the average stock in the market. And this is called volatility. It's a way of summarizing all of this. I won't get into it today. But the bigger volatility is, the wider this is. Look at McDonald's. Volatility is less than 30%. So look, it's not as wide. They're less unpredictable. The average stock is more unpredictable. McDonald's is more predictable. And out of every 100 years, 24 times, not 11 times, more than twice as much as they're in this range of around 10%. So they're safer. And look, their volatility is lower. So they're a pretty good company. And you got to kind of believe that, right? Because they've been out there and existing and doing well for so long. All right, the Treasury issues 10-year bonds. Again, I won't explain in detail what that is. It's the U.S. Treasury, 10-year bonds, and they typically make 6%, but their volatility is only 3%, very low volatility. Okay, their average is 6%. And look, they don't make less than zero. You can't even make -10 with those, but you can't make a lot with them either. Okay, you don't deserve to if you don't want to take any risk. That's basically what the market's saying. So here's the S&P 500. That's 500 different shares all mixed in one portfolio for you. So the average is 12%. Like the average stock, I'm going to go back here real quick. The average stock is 12%. However, this is a portfolio of a bunch of different stocks, and there's a lot less risk, 16% risk. Here's General Electric, 13% return. And here is McDonald's again, 15% return, better than General Electric. Volatility a little higher, also General Electric, a little lower volatility, just for comparison. Okay, now let's look at bonds. This is a kind of bond called a junk bond, a high yield bond. And this is a bond that, say, a company has issued, and there are these bond ratings, okay? And look on this in this box. These are very safe bonds, and they pay a very low amount of interest because they're safe. But when you get into riskier bonds, they pay higher interest. And right here, these bonds are called junk bonds, and I put them in here just to make you aware. They're not junk. They're high yield bonds, and they're only a little bit more risky than these investment grade bonds, but they actually pay really well. They have an average return of 8%, but very low volatility, okay? Let's see. So this is U.S. investment grade. Oh, these are investment grade, excuse me. These are the safer bonds. These are these guys. Let me start over on that. They make 8% with low volatility, but look at these guys. They make 11%, quite a bit more, and they do have more volatility, but it's not too crazy. All right. So this is the wrong title up here, and that's okay. I'm going to skip this. We're going to get into risk and return summary. Here we go. Here's what you're going to end up learning if you get into these courses in more detail. I've really flown through this. You're going to look at treasury bonds and see how much they make. Green is return and red is risk, volatility. You're going to see how much you make here and how much risk you take. We were looking at some of this in the charts. Here's how much risk you take if you buy a global hedge fund. Okay, you get about 6%, and you've got a risk of 11%. Investment grade bonds, safer bonds, 8% return. But let's look at the green ones real quick, compare them. As we go to the right, they get higher. That was the whole idea behind the chart. But then look at the red ones. That's how risky these guys are. Not very dangerous, quite dangerous. Hedge funds, not so dangerous, more dangerous, okay? Very dangerous. This is an individual stock. This is the S&P 500, right? That's made of 500 of these stocks, and they have the same average return, but a lot less risk because it's diversified. Here's General Electric. Here's McDonald's. And here are the top 100 hedge funds. They do well. They make 15%, and they don't have very much risk. However, they've really made more money than that, and you end up getting less because you pay them a big fee. This gray area is the fee you pay them. So really, they make this much up here at the top, but you pay them a fee. All right? Here we go. Quiz questions. Let's go back to these. Okay? Here we go. Here are the answers to these quiz questions. Based on what I just went through, if we had time to go through it slowly, we would see that an average individual stock earns about $10 per year, $100 of stock. That was that 12% number for McDonald's, okay? You can measure it different ways, and it ends up, depending on how you measure it, it could be around $10 for every 100. How many years out of 10 does an average individual stock lose money? D, 4 out of 10 years. But if you have a diversified portfolio, portfolio would be the S&P 500 index. You would only lose money 2 out of 10 years. So you would have the same average profit, but you would have half as much risk. How much does a $100 U.S. Treasury bond pay per year? About $5. Okay. Look at bonds. Stocks pay twice as much, right? But how often do they fail? They don't fail. If you hold them to maturity, they have never, U.S. Treasury bonds have never defaulted, it's called. So now you know 5 of the most important numbers in investing. Here they are. Out of $100, if you invest $100 in stock, you make $10 on average a year. Okay. And if you only own an individual stock, Okay, you'll lose money 4 out of 10 years. That's often, that's not good. But if you own a whole variety of stocks altogether, because some go up and some go down, they offset each other's risk, you'll only lose money 2 out of 10 years or 1 out of 5 years. These are round numbers. And then treasury bond investing gets you about $5 per 100, and it's less now because rates are low. It really only gets you about $2 or $3 per 100. And then, but you'll never lose money, okay, if you buy bonds. Okay, we're starting to move here. Let's set a budget. Here's your budget. Here's your balance sheet, how much cash you have and how much you have in investments in your house and everything. And here's everything you owe. There's your budget, your assets, your liabilities, and this is how much your net worth is. That's your assets minus your liabilities. We won't get into liquidity, but essentially liquidity is how much money you could get really quickly if you needed to. And here's your cash flow. Your cash flow, ignore the top for a second, is your income, okay? And how much you spend. What do you do with this income? So you got 17,000 and change of income coming in this example, and you spend it on stuff. Some of it you save, some of it you reinvest in stocks, some of it you pay a mortgage with, on and on and on. This is what you use your cash for. So now you've got a budget, okay? And that's it. We've got through this bullet point. So now we're moving. Okay, so now once we see, here's what we see in our budget. $1 million budget makes investment income of about 95,000. I won't go back into that, but it did. It was in there. Tax rate being 20%. There's a way to calculate gross investment income because on the budget we had net investment income. So you do this little math. We're not going to do it today. You fill in a formula. This is how much you really want your portfolio to make. 120K on $1 million. Okay, and to make 120K on $1 million is 12%. Guess what makes 12%? The S&P 500 makes 12%. There are ETFs that imitate the S&P 500. So our strategy is going to be, we're going to open an account and buy the ETF that mimics the S&P 500. We have now set an investment goal and strategy. That fast. Now we're going to select the type of investment account. Here's what we're going to do. We're going to see if we want a broker, an online platform, a financial planner, an investment manager, or a hedge fund. Okay. Here's the thing. Brokers do these things. They fill orders. They provide on an online platform. Brokers, online platforms, and investment managers can fill your orders efficiently. All right. Brokers, online platforms, and financial planners provide investment services. Okay. Maybe there should be a check here. It's okay. Oh, investment advice. Let me back up. These guys, they do some of that. These guys do more of that. That's where I'm going. Going a little too fast for my own britches. Okay, but who does a big analysis is these guys. Analyze your assets, financial planners. Investment managers do that too, some of that. Who really completely manages your investments for you? You go to sleep, you don't worry. Online platforms could do that. Investment managers do that, hedge funds do that. Who provides reports about your portfolio? These people do, because this guy's not really managing money, he's just giving you advice, he or she. These guys have a lot of neat stuff like data filters, charts, a lot of tools. These guys educate you. These guys have something unique, all right? Here's where these guys are unique. They can make money when markets are going down because they get to use much fancier stuff than the other guys. And here's a chart that I would walk you through. This chart does this. It's the same. It ends up coming to the same kinds of conclusions. It asks you questions like, are you techie? Are you not techie? You know? Do you want someone to do a thorough analysis of your stuff, or are you highly independent? If you want somebody to do a thorough analysis of all your assets, go to a CFP. If not, you're highly independent, you skip this guy. And you go to, if you're highly independent, way over here, you either open your own account or get a broker. If you're not highly independent, but you have a big portfolio, okay, if you have a big portfolio and you want to invest for a year or more, okay, and you're something called an accredited investor, you could buy hedge fund shares. We won't get into this stuff in detail, but basically you're an accredited investor if you have a lot of money. If you don't have that much money, okay, then you would go to an investment manager. That's what this teaches us. So this is this chart, okay? This helps us decide where we get to end up on this chart, okay? That's what this does. All right. So there's some logic there. We're not just flying blind. There, we're near the end now. Online investment platforms. Here's what they offer. Computer access, right? Meta-functional, organically evolving interfaces. These guys have sharp-looking screens, and they keep making them better every day. They do auto tips everywhere on the screen. You touch them, they give you hints about how to use it better. The thing is like reading your mind. It's uncanny. They use artificial intelligence to give you auto tips. They give you market watches. They give you abilities to chart. They give you, you could do live trading or preset trading or automated trading. They have everything, access to everything, stocks, bonds, mutual funds, indexes. You could do something called margin investing, borrowing to invest, and a lot of auto investment management tools. I mentioned that earlier. 24/7 access to markets, 24/7 customer service, lots of training. They even let you use the account as a checking account. Here we go. I did a big detailed analysis, okay, of other analyses that were made. Stockbrokers.com did an annual review, okay? They compared a bunch of brokers, and there's a bunch of information on this slide about that, and you can go online and find information about that. So you can go to stockbrokers.com and find their 2020 annual review, or you can find the Barron's 2019 annual review, and you would be able to do kind of what I did, but I did it in a big spreadsheet that I will be presenting in future shows. So that this thing right now here only has like 30 lines. The real one has 120 lines of different features that I compared for Charles Schwab, E-Trade, Fidelity, Interactive Brokers, TD Ameritrade, and TradeStation. By the way, I will not be going this fast in the normal MorAlpha show. This is just to really hopefully keep you on your toes this time and make you aware that also I will not be wasting your time. I will be working very hard, okay? All right, and I'm gonna show you some screens from Interactive Brokers. They are my online platform. However, we're gonna be looking at what's called a paper account, a practice account. It's not a real account. They let you do this. You open up an account and you really have two accounts, the real account, but you have an account where you can practice and they put pretend money in there for you, $1 million, and then you pretend like you're trading, okay? Here's what the screens look like. We used to pay $1,600 a month, and they still do, to have these screens on trading floors. Now this is free. This is incredible. I never thought I would see it. So this screen even has live streaming on it, okay? Now we're gonna look at how these windows are laid out. So here's a ticker. That's the company you're looking at, you're analyzing. Could be any one of these companies or another company. Okay, there's the order window. This is the window where you buy and sell. Here's the buy and sell button. Okay, here's a chart window. You can either chart anything here, or you can chart this guy, the ticker you've selected. And ticker is just a symbol that represents the investment you're going to make. So every currency, every option, every futures contract, every stock, every bond has an identifier called a ticker. That's all that is. Here's a scanner window, and you can set up the scanner right here. You can edit it, and you can have it scan whatever you want. Big companies, small companies, environmentally friendly companies, companies that are failing, companies that are succeeding, whatever you want, you can use this scanner to find them. Okay. You all the orders that you place up here end up in this window down here, and you can keep track of the orders you placed, orders that got filled for you, which typically is instantly nowadays when you place an order. It's incredible. Or orders saved. You can save an order but not place it and have it ready so that when the market moves where you want to be, bam, you can push the button and you can, instead of typing in the work and putting the order, like putting in the quantity of shares you want to buy, you'll have it already, the quantity of shares and what price you want to buy it at, under what conditions. And here you can have news scrolling, and you can tell it what to scroll. Scroll randomly, whatever it scrolls to everybody, or scroll what you tailor that you want to scroll. Maybe only stuff in your own portfolio. You can tell it that. And so this talks about that there is also a library of scanners that are already created for you that already are typical scanners people have set up. So you can set up your own scanner, or you can use their presets, and it determines what's in here. And everything has a ticker. We already said that. Okay, and you get daily market reports with stuff like international, general briefing. We're down to the end here. On this screen, you place an order right here in this window. I mentioned that window already. Okay, you configure your order window right here, and you can do an automated portfolio. This is what it looks like when you pick a portfolio and it's doing the trading for you. And this looks at the history of how that portfolio would have done in the past before you bought it. It's called back testing, which is incredible. So I'm running a little over. You can hang or not. I started late, slightly late too. Here are training resources. You can pause this when you look at it later. You can go online and look at these resources. They're available, and the platforms make them very available. We've gotten through everything, and now I'm going to really fire through in 1 minute. Give me one more minute, these last two sections. Here's what I'm going to do. I'm going to show you my seminar, pieces of my seminar. It's 100 slides, but I'm only going to show you a few slides, and I'm going to show you what I'm doing for community. So here's the Investment Universe seminar, all right? Here's my mission. Here's my agenda. Here's my goal. Here are my goals. Here's an overview window. I compare investing and gambling. I talk about this model. The people who came up with this model won the Nobel Prize for this model. This is the optimal portfolio model, okay? So that I will teach that in seminars, and I will teach that in Get MorAlpha shows, okay? I'm going to teach about investment banking careers and how you get an interview. I'm going to teach you what a day is like on Wall Street. I'm going to talk about hedge funds. And look at this guy. He made $4 billion in 2013. I'm going to update this chart. The average leader of the top 25 hedge funds made 18 times what the average CEO of a large company. Of the top 25 CEOs made 18 times, 1/18 of what the top 25 hedge fund managers made. Unbelievable. Okay, my last 30 seconds. Here I go. Community. Here's what I'm doing for community. I'm doing seminars for junior high and high school students. And here's one I wrote for a school in Indianapolis. I haven't presented it yet. I started off getting the kids very quiet. I do a countdown. Okay, get them real quiet. Do a countdown. Let them visualize. Get them inspired. Tell them how great humans are. Tell them we conquer adversity. Tell them we fly. I take my time. Tell them we are fascinating. And then I make the title of this fascination. And this was a school that I had prepared this for. I didn't get to present for them yet. Okay. And so we go through our objective. Okay. And we get through from fascination to action. That's the goal, right? Hopefully I'm going to fascinate you today. And I'm going to prove to them how lucky they are. Luckier than an actor, luckier than an athlete, luckier than a singer, luckier than a lottery winner. I'm going to show them how lucky they are for so many reasons. We have this amazing universe that actually gives us life. It's incredible. Okay. And then I tell them you're lucky because I'm going to take you out a walk down Wall Street and because there's a bonus at the end. So I talk about the universe and how cool it is. I talk about, now I'm really cheating on time, about different things in science that are amazing, like that the fact that space curves, and I teach them about physicists. And again, these are just a few slides. This is a 1 hour presentation that I've compressed into 1 minute here. And then I hit them with the surprise. And the surprise is to visualize themselves. And here you go. These are inner city students. Oh, enjoy this, please. Take the time. I say visualize your name on that diploma. Look at that where it says your name and don't let it be your name. Stare at it and put your name in that thing right there. Okay. Put your name in a beautiful font in there and you grab this thing and you put it on your wall and you will have it for the rest of your life. Okay. Then you picture yourself on a university campus, walking with your fellow students. You picture yourself making your life your work of art. Picture yourself when you finish school and how you could make your life into what you could dream it could be, a work of art. Picture yourself doing things like traveling around the world, seeing what's on the other side of that horizon. Picture yourself continuing to paint. This is free form. This is impressionistic. This is whatever you want it to be, and you have kids now. Picture yourself enjoying music and picture yourself in an amazing home and picture yourself looking back on an amazingly, beautifully lived life. Picture yourself, dream. Good luck to all of you who watched this 1 hour and 5 minute show I went over. I am always here. I say that to my students. I certainly say it to all my Get MorAlpha viewers. Thanks for hanging out. I am Mora, host of the Get MorAlpha show, host of the seminars. I look forward to seeing you next Monday and streaming you next Monday. And I look forward to meeting as many of you as I can at seminars. They will start small and hopefully get really bigger because the revolution is on and we're going to lead that revolution. Thank you. So once again, here I am full screen now. And I'll give you one more thank you if you're still hanging with me. For those of you out there who know me really well, know I've been working on this. You can now, everybody else can hang up and the rest of you can hang out in the studio for a moment after the show, post show. I'm happy with how it went. It was a little long and I had to rush more than I thought I was going to have to rush because I was slow at the beginning, but that's not the first time I've seen that in a presentation. And I don't mind. I had a good challenge here getting ready. The last 5 minutes before I started presenting actually were like you might have imagined, making sure that my monitor was working. I have a monitor up here that's a telephone and it wasn't working. And all of a sudden I wasn't streaming and I realized that I shut down a tab in YouTube, and that tab, I have to be signed into YouTube to do this. I didn't know that. And so when I had done practice runs, like I've done a half dozen practice runs, I'd always been logged into YouTube, but today I wanted to be streamlined. So I turned everything else off and I couldn't get in. This is 5 minutes before the show. And so it gave me a hint. The live stream program, it's called Lightstream, is my host. and it's fantastic. So I'm going to give it a little demo. So I've got 3 scenes set up. We're in the scene number 1, which I almost didn't use, just at the very beginning and now here at the end. Scene number 2 was the one with the presentation, and scene number 3 was the one that was the intro before I started. So this is cool. And I can mute the microphone. So here I am. You see me talking, but don't hear me, and now it's back on. And you can add stuff on the fly here. You could go to other sites that I have up. You can go to other applications so you can watch somebody type in a word program. So this is amazing. All right, that's it. That's enough. Thanks for hanging out, everybody. Al Mora, checking out. Looking forward to doing so much more of this. I had been retired for 7 years, and for the last 2 weeks, I have been going bonkers. I've been going as hard as I can to get caught up on what is out there in the markets, what these products are. And I'm going to try to be, and I won't try to be, I will be current when I come to you. I will be showing stuff to you real time. Another fun thing we'll do is we'll be looking at real markets too. I didn't do it today, but each show and each seminar will feature stuff that's going on out there in the markets. For example, we have coronavirus right now happening, and we have politics happening. And I'll say a quick thing on politics. You're going to get this from me over and over again. I hope you won't be angry, won't be frustrated by what's going on ever in your life in politics, no matter where it goes, no matter how against you may feel it's going. And then, of course, if it's going your way, well, good for you, celebrate. But the reason I say that is there are people who face adversity way worse than the fact that maybe they have a grumpy president with kind of a foul mouth. Not that I forgive that. I don't like that. But I'm saying there are worse things, far worse things, and humans face these challenges with integrity and dignity. Right now, people are going through health issues. Some people know that their days are numbered, and they're going through it with their dignity and integrity intact. So let's go through our lives that way. Let's not get overly excited, overly frustrated. Let's not act from anger and hatred. Let's always stay in our integrity. Let's stay in our self-control. Let's do that. We can do it. Let's do it. I encourage you. I hope I can inspire you to be that way. That's my word on politics for the day. All righty. Checking out Al Mora. Have a great week. See you.